Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover several questions from Cengage's Chapter 1, the Individual Income Tax Return. So before we look at this question, just to ensure that you have an understanding of the background of the history of taxation in the U.S. So the first tax that was ever imposed was with the passage of the Revenue Act of 1861. And this was introduced during the Civil War to help fund war expenses. And it was a temporary 3% tax on annual incomes over $800. However, this Revenue Act, it was repealed 11 years later in 1872, but the government, they came to realize that they needed a permanent income tax because there was industrialization, the growth of very big corporations, and there was a great amount of wealth inequality. So there were two major court cases. The first is the Wilson Gorman Tariff Act of 1894 and Pollock versus Farmers Loan and Trust Company in 1895. In these two court cases, they essentially played a pivotal role in helping to shape the federal income tax system in the U.S. So essentially, they found that taxation was not constitutional. So what did Uncle Sam do? They put it in the Constitution. And the 16th Amendment was proposed in 1909 and ratified on February 3rd, 1913, and it established a permanent legal income tax. So the correct answer is the 16th Amendment in 1913, and the 16th Amendment states the following: Congress shall have power to lay and collect taxes on incomes from whatever source derived without apportionment among the several states. So what that simply means is that at the federal level, everyone pays taxes, but depending on your state, you may or may not be subjected to taxation. This question states, indicate whether the following statements are the major purposes the tax system was meant to serve. Select yes or select no. So here we see the first option asks us about raising revenue. So as we know, one of the main things about taxation is obviously to raise revenue for the government, but it's multifaceted. So A is obviously yes, this is one of the purposes of income taxes, to raise revenue. B says to discourage states from levying income tax. No, obviously this is not true. To discourage states from levying taxes, it is not a goal or a purpose of the federal tax system. Again, essentially each state, they do things a bit differently. C, furthering economic goals such as reducing unemployment. This is correct. So there's some economic goals. There's also some social goals, essentially why taxes are in place. So C would be yes. D states furthering social goals as encouraging contributions to charities. So yes, as mentioned, there are some economic goals and there are also some social goals as it relates to taxation. E states to encourage the redistribution of wealth. This is actually no. So although there's some social policies that help to govern the course of tax policy, the nature of these policies is not necessarily to redistribute income or wealth. So A would be yes, B, no, C, yes, D, yes, and E, no. Next, we move on to this problem where it asks us about filing statuses. So it says select from the drop down the generally preferred filing status and other filing status that are available in each of the following independent cases. So as we know, there are 5 filing statuses. The first is single, the next is married filing joint, then we have married filing separate, we have head of household, and we have qualifying widower or surviving spouse. So before we go through 1 through 6, we're going to give a quick overview of essentially these different filing statuses. So single, what that simply means is at the end of the year, by December 31st, you are unmarried and without a dependent. Married filing joint, that means exactly what it is. You are married and you are filing a joint return with your spouse. Married filing separate, you are married, but you're filing a return separately from your spouse. Head of household, this is essentially for an individual that is unmarried. However, they have either a qualifying child or they have a qualifying relative. So keep in mind, head of household, you are unmarried, but you have a qualifying dependent, which can either be a qualifying child or a qualifying relative. There's also a caveat. Let's say an individual is married, but they have what's called an abandoned spouse provision. So what that simply means is that you're married, but you lived apart from your spouse for the last 6 months. So even though per the IRS tax law, because you have a dependent and you were apart from your spouse, you can file as head of household if you meet those requirements to be deemed an abandoned spouse. Lastly, we have qualifying widower or surviving spouse. This is essentially you were married and your spouse passed away. And if you have a qualifying child for the next 2 years, you can claim the qualifying widower or surviving spouse. So you essentially get the same standard deduction and tax rates as though you were still married. All right. Because obviously, if you married, the loss of income, it can have a great financial weight on someone. So Congress recognizes that, and obviously that's why it's part of the tax law. So for case one, it says the taxpayers are married on December 31st of the tax year. So keep in mind, it's asking the preferred filing status and other filing statuses that are available. So your first train of thought might be, okay, they're married filing joint. We don't know their situation. They might want to file married filing joint, or they might want to file separate returns. We don't know. So the correct answer would be married, filing a joint return, or separate returns. Next, we see the taxpayer is single with a dependent child living in her home. So based on this fact pattern, this would be head of household. Obviously, there are some rules. The child needed to have lived in a home for more than 1/2 of the year, but based on the fact pattern, we are assuming that such is the case. Therefore, this single taxpayer with the dependent child would be head of household. 3, the taxpayer is unmarried and living with their girlfriend, single. If you are not married, there are some states where they do like common law marriages and things of that nature, but for the most part, on the federal level, Uncle Sam is not having that. State might be a little different. 4, the taxpayer is married and their spouse left mid-year and has disappeared. The taxpayer has no dependents. All right. So they're married, but the spouse left mid-year. So remember, the last 6 months of the year, they need to be alone. They have no dependents. So based on that, head of household will not apply simply because there's no dependent. Therefore, the individual needs to file a married filing separate tax return. 5, the unmarried taxpayer supports her dependent mother who lives in her home. So obviously a dependent mother is not going to be a qualifying child, but a qualifying relative. For the most part, with a qualifying relative, the individual needs to live in the home for the entire year. But one of the exceptions is that when it is for a parent, the parent doesn't need to live in the home. So in this case, head of household. And lastly, the taxpayer's wife died last year. His 15-year-old dependent son lives with him. So in such case, this is qualifying widower or surviving spouse. So it's very important to understand these different filing statuses, because based on the fact pattern that the client presents to you, the situation might change, right? And each year it could be a little different. So you always want to make sure each year that you ask clients the appropriate questions to ensure that you are choosing the preferred filing status based on their situation. Next, here we see in the preparation of her tax return for 2023, Joan should file as says Joan, who was divorced in 2023, had filed a joint tax return with her husband in 2022. During 2023, she did not remarry and continued to maintain her home in which her 2 dependent children lived. In the preparation of her tax return for 2023, Joan should file as, all right? So it lets us know she was divorced. She filed a joint return the year prior. 2023, she didn't remarry. She maintained a home and there were two dependent children. So based on this fact pattern, she's not married filing joint. She's not married filing separate. Head of household seems like a correct answer. Of a surviving spouse, did the spouse die? The fact pattern says that she was divorced. So therefore, A is not, a D rather, is not the correct answer. So the correct answer would be C, head of household. Now we move on to discussing what's called the standard deduction. So as it relates to the standard deduction, to make it easy, just think of it as an amount of money that the IRS allows an individual based on their filing status and their age to keep tax free. So in addition to that, we have what's called itemized deductions. So itemized deductions, these are basically personal expense items that Congress allows as tax deductions. So this includes medical expenses, certain interest expenses, charitable contributions, and things of that nature. Also casualty losses. So that would be reported on what's called Schedule A that lists the itemized deductions. Keep in mind, certain itemized deductions, they are subjected to limitations, but the key thing is for a taxpayer, as we have learned about the tax formula, they take the greater of the standard deduction or the itemized deductions in order to determine their taxable income. So here it states, mark each statement below as either true or false regarding the standard deduction and itemized deductions. So A states the standard deduction is an amount that varies with filing status. This is true, right? So depending on if you are single, married, filing joint, head of household, etc., it varies. There's also an additional standard deduction based on your age and based on your vision if you are blind or not. B, a taxpayer should claim the smaller of the standard deduction or the total allowed itemized deductions. This is false. So as just mentioned, we start off with gross income, we subtract deductions for adjusted gross income, which gives us our AGI. And then once we get our AGI, then from there we take the greater of the standard deduction or the itemized deductions. The key thing is we want to reduce the taxpayer's income that's subjected to tax as much as possible. C, total itemized deductions depends on the amount and type of items, with some having limitations based on AGI. So true, as just mentioned previously. So medical expenses, those are subjected to a limitation of 7.5%. Taxes, state and local taxes, there's a cap of $10,000 in light of the Tax Cuts and Jobs Act. Charitable contributions, miscellaneous deductions, all right? So a good majority of the itemized deductions, there are some limitations set in place based on the adjusted gross income. D states taxpayers who are 65 years of age or older or blind are entitled to an additional itemized deduction. So this is actually false. So taxpayers that are 65 years of age or older or blind, they are entitled rather to an additional standard deduction amount. So this fact pattern seems correct based on the verbiage, but the key thing why it's false is because it says an additional itemized deduction amount when it actually should be an additional standard deduction amount. Hence why it is incorrect. And just keep in mind, let's say a taxpayer is both 65 years of age or older and they're blind. In such case, they're entitled to two additional standard deduction amounts. So just keep that in mind. All right, so we're continuing in the same concept, talking about the standard deduction. It states for each of the following independent situations, determine the amount of the standard deduction that the taxpayers should claim on their 2023 income tax returns. So the standard deduction for 2023 for a single individual is $13,000. $850. And one key thing to keep in mind is that each year these amounts essentially change depending on the situation. Well, depending on inflation, rather, I should say. So for 2023, as we see here, for a single individual, it is $13,850. And there have been some adjustments, obviously, for the new year. So for 2024, for a single individual, the standard deduction is $14,600. And I'll actually show you so that way you can, just understand and see how the adjustments work each year. Again, it is adjusted for inflation each year. So here is, a comparison between the two. So for 2023, the single standard deduction is $13,850. For 2024, the standard deduction is $14,600. For married filing joint, the standard deduction in 2023 is $27,700. And for 2024, it's $29,200. For married filing separate, one thing you'll realize is that single individuals and married filing separate, they're essentially treated the same standard deduction. Head of household for 2023, the standard deduction was $20,800. And for 2024, the standard deduction for head of household is $21,900. And for surviving spouses, as we see, married filing joint standard deduction for 2023 is the same, $27,700. And for 2024, that amount increased and is the same as a married filing joint couple. The standard deduction for 2024 is $29,200. All right, so based on this information, here it states Adam is 45 years old, in good health, and single. So based on this fact pattern, for 2023, Adam's standard deduction would be $13,850. If we're looking at 2024, it would be $14,600. Here it states Bill and Betty are married and file a joint return. Bill is 66 years old and Betty is 60. So based on this fact pattern, all right, we essentially see that, hey, Bill is 66 years old. So in such case, let's get our handy dandy calculator. And we need to factor in the additional standard deduction. So $27,700 for married filing joint, but Bill is above the age of 65. So therefore, we add the additional standard deduction of $1,500. So their total standard deduction is $29,200. All right. And then for 2024, instead of $1,500 for Bill, the additional standard deduction would be $1,550. All right. Next, here we see Charlie is 70. He's single and he's blind. So based on that, based on Charlie's fact pattern, he's single, $13,850. He's above the age of 65, so $1,850. But then it also says that he's blind, so he also gets an additional $1,850. So therefore, in Charlie's situation, the total standard deduction is $17,550. $13,850 for the regular standard deduction, $1,500. $850 because he is above the age of 65, and then $1,850 because he is blind. For 2024, these amounts were increased essentially to $1,950. So again, each year increased for inflation. Here we see for question 4, Debbie qualifies for a head of household filing status, is 35 years old, and is in good health. She qualifies for head of household, $20,800 for 2023, and for 2024, that amount would be $21,900. Here it states, Elizabeth is 9 years old and her only income is $3,600 of interest in a savings account. She is claimed as a dependent on her parents' tax return. So because she's a minor, Elizabeth's standard deduction is limited. The total standard deduction for Elizabeth cannot exceed the greater of $1,250 or the sum of $400 plus her earned income. So in this case, because she has no earned income, she just has passive income, which is this interest earned on a savings account. In such case, the standard deduction is $1,250. So this fact pattern digs a bit deeper into what's called the kitty tax. You'll essentially see this more so when you're dealing with high network clients and they kind of shift income or they have brokerage accounts and things of that nature in the name of their child. Lastly, we have Frank and Frida are married with two dependent children. They file a joint return and are in good health, and both of them are under the age of 65. So in such case, Frank and Frida are married filing joint. Their total standard deduction is $27,700 for 2023, and for 2024, $29,200. So this brings us to our next problem. And here it states, calculate the following amounts. So it states, Bill is a single taxpayer, age 27. In 2023, his salary is $35,000 and he has interest income of $1,400. In addition, he has deductions for adjusted gross income of $2,000 and he has itemized deductions of $8,300. Calculate the following amounts. All right. So based on this information, we need to calculate this for Bill. So I have an Excel spreadsheet that we will essentially use. So that way we can calculate the gross income, the adjusted gross income. We will determine between the standard deduction and the itemized deduction. And then we will calculate the taxable income. So as it relates to the individual income tax formula, it is as follows. We start off with the gross income. We subtract deductions for adjusted gross income. That gives us our AGI. From there, we subtract the greater of itemized deductions or standard deduction. We subtract the qualified business income deduction. It doesn't apply in this case, but this is for those individuals that have a business. From there, we get our taxable income. We align it with the tax rate. We determine our gross tax liability. We subtract any tax credits and prepayments, and that determines if the client has a refund or a balance due. So in this case, Bill has salary of $35,000, interest income of $1,400. So therefore, the gross income is the salary plus the interest income. So we have gross income of $36,400. And then now the next part of the question is asking us to calculate the adjusted gross income. So now as it relates to the adjusted gross income, it lets us know that he has deductions for adjusted gross income of $2,000. So we bring down our gross income, and from there, we factor in the deductions for adjusted gross income. We get the sum, $36,400 minus $2,000. The adjusted gross income for Bill is $34,400. So now the next step, we need to determine, well, what's the greater of the standard deduction? So it lets us know that Bill is single. So the standard deduction will be $13,850. And the problem lets us know that he has 8,300 of itemized deductions. So we compare the two. We know that we are taking the greater of the standard deduction or the itemized deduction. So here is how it would work, right? Again, the key thing is that we want to subject Bill to the least amount of taxable income as possible. So 34,400, and let's say he took the itemized deductions. Qualified business income is 0. So in such case, if Bill were to take the itemized deductions, his taxable income would be $26,100, right? But let's say, and I'm just doing this to, clearly show you the difference between the two. If he takes the standard deduction, Now we see that the taxable income is only 20,550 in comparison to 26,500. So he basically gets to keep about $5,000 more of income. Which one do you think Bill is going to choose? Bill is obviously going to choose to claim the standard deduction. Again, obviously, if he's married, filing separate, and his spouse itemizes, then he has no choice. But in this case, Bill is single. So therefore, the taxable income will be 20,550 after he claims the standard deduction of 13,850. Taxable income is 20,550. So we would not claim the itemized deductions. It works better in Bill's favor to claim the standard deduction. All right, so this brings us to a similar problem, but now instead of just calculating the taxable income, we are also going to factor in determining what the tax liability will be. So here we see Brock, age 50, and Erin, age 49, are married with 3 dependent children. They file a joint return for 2023. Their income from salaries total 52,000. So I'll start to input the fact pattern. 52,000. They received $8,000 in taxable interest, $5,000 in royalties, and $3,000 in other ordinary income. So if we add the salary of 52,000, interest income of 8,000, royalties of 5,000, other ordinary income of 3,000, Brock and Erin have gross income of 68,000. So we solve that, 68,000. And now we bring the 68,000 down and we factor in, well, okay, do they have any deductions for adjusted gross income? So the problem lets us know that they have deductions for adjusted gross income of $2,750. So we factor that in. And now we have to determine between the standard deduction or the itemized deduction. So the standard deduction for married filing joint would be 27,700 versus the itemized deductions, which the problem lets us know is 28,000. And as we've seen in a previous problem, we take the greater of the two. 28,000 is greater than 27,700. So therefore, we copy our adjusted gross income, which we calculated previously. We take the greater of itemized deductions or standard deduction. In this case, it is the itemized deductions of 28,000. There's no qualified business income. So therefore, the taxable income for Brock and Erin is $37,250. All right. So now the next thing we essentially need to factor in, and we can start to bring these numbers down. So the gross income as we calculated was 68,000. The adjusted gross income of 65,250. We take the itemized deductions, which is the greater of the two, and taxable income of 37,250. So now based on this, we calculated the taxable income, and the problem gives us the tax table. So we click on the tax table and we use the tax table as follows. So I'm going to make this bigger. So we know the taxable income is 37,250. So how this table works, essentially, it says if line 15, which is taxable income, is at least but less than, and you are one of the 5 filing statuses: single, married filing joint, married filing separate, head of household, and we know married filing joint, these tax rates also apply to qualifying widower. So now we know that the taxable income, as we just calculated, was 37,000. So we need to get to the chart where it shows 37,000. So here we are. So we're in the chart with 37,000, and we know that the income was 37,250. So therefore, in such case, the income is at least 37,250, but less than 37,300. So therefore, we need to look at the second column. So it's basically like we're connecting the dots. We scroll down and then we scroll left. So therefore, the total tax for Brock and Erin would be $4,033. And again, that's using the tax table. Generally, when you are using the tax software, it automatically calculates this information, but it helps to know how this amount is calculated. So the income tax liability will be $4,033. All right. So this brings us to our next problem. And it's pretty similar, using the filing status and tax computation. It's asking us to determine the income tax liability for these clients. So we have Alan. So we have the information up above. We have Alan. He's single, taxable income before the standard deduction of $36,000. Boyd, married filing separate, $38,200. Codwell, married filing joint, $64,020. Dell, head of household, $50,922. And Evans, single, $59,033. Right? So essentially similar. Now, the first thing we need to do is we need to determine the standard deduction for each. So we know for a single individual, tax amounts would be as follows. So for the single individuals, we'll just input it $13,850 for 2023. $13,850 for 2023. For married filing joint individual, the married filing joint would be $27,700. For a married filing separate individual, it's the same, $13,850. So you can refer to the chart. I just know these off my head. For head of household, standard deduction, $20,800 for 2023. So again, this is the AGI before the standard deduction, and we know the standard deduction amounts. The problem doesn't tell us anything about itemized deduction, so we just assume that their standard deduction is greater than the itemized deduction. So 36,000 minus 13,850. 38,200 minus 13,850. And the great thing with using the Excel, you can essentially just drag it down. All of the formulas would apply. Oh, actually, we need to do sum. That is my apologies. That's the thing. With Excel, it definitely follows the order of operation. All right. So just in case you're not aware, in this case, it's 36,000. And before I was adding a negative. So adding a negative and a positive, obviously, has a negative implication. So what you need to do if you're using an Excel spreadsheet, it would be the sum of the two. You don't want to add it because obviously the signs will have an impact, and before it was adding it when it should have been subtracting. So 22,150. So what we need to do, we have this chart here. We look at the information for Alan, and we know Alan is single. So Alan has income of $22,150. So now let's, figure it out. And we know that Alan is single. So he has at least 22,150, but less than 22,100. So therefore, based on this information, Alan's tax liability would be 2,441. All right. Next, for Boyd, we see Boyd's income is 24,350, and we know that Boyd is married filing separate. So as a married filing separate individual, 24,000, at least 24,350, but less than 24,400. So in such case, let's see. Up here we go. Married filing separate, 2,705. Next, we see for Codwell, he is married filing joint, and the income is 36,320. So now we see at least 36,300, but less than 36,350 for a married filing joint individual. It will be 3,919. Dell, who's head of household, has income of $30,122. So 30,000, at least 30,100, but less than 30,150. So as a head of household, the tax liability will be 3,301. And then lastly, for Evans, who is single, has income of 45,000. 153, so at least 4,150, but less than 45,200. Therefore, the income tax liability would be $5,246. So with this problem, I mean, this table, it essentially points you to the amounts. But another thing that I want you to keep in mind is that the tax rates work as follows. So this table essentially does all of the computation to you, and I just want to show you quickly, how it works. So once you get the taxable income, generally there's a tax base, and with the tax base, there's some excess income essentially. I'm going to quickly pull it up so that way you can see how it works to get a greater understanding. So tax. All right, so I'm going to pull that up shortly so we can essentially see how these amounts work so you can get a better understanding. It's very important to understand this, especially if you want to venture into, you know, tax planning. You want to be able to better advise your clients. Here we go. I'm trying to find one with single so that way it'll make a bit more sense. All right, so here we go. I believe I found one. All right, I believe this one is for single. All right, let's see. Oh no, here we go. All right, perfect. So we're just going to use an example for a single individual, right? So that way you can see how it works. So we see for Alan, we calculated that the tax was $2,441. So we use the tax table. Now we're going to use the tax rate. Again, I want you to be able to understand how this works. So I'm going to copy this and actually paste it so we can just be all in the spreadsheet. Perfect. So for Alan, I'm going to hide these so that way there's no confusion. So for Alan, the adjusted gross income was $36,000. The standard deduction was $13,850. So that is how we calculated this $22,150, right? So based on this information, we see here that this is the tax rate. Again, we looked at the tax table prior. So here it's saying for a single individual, if their income is over $11,000, but less than $44,725. So based on Alan's situation, we see that his taxable income is $22,150. So he falls within this range. So based on that, the tax base is $1,100. And then it says, in addition, the excess tax on income is 12% of all income over 11,000. So based on that, taxable income of $22,150 less the threshold of 11,000. This needs to be a negative, right? Less the threshold of 11,000 because again, it says excess over 11,000. So therefore, Alan's excess income is 11,150. So based on that, all of this 11,150 is going to be subjected to 12%, not 10%. So therefore, 0.12%. So for Alan, $1,338. How did we get that? 11,150 multiplied by the 0.12, the 12%. So in order to determine the total tax, it's the tax base plus the tax on excess income. So we see here that there's off by a few dollars, but for the most part, this is essentially how the amount is calculated. So the tax rate table basically makes it easier for you. It just shows you all of the, amounts factoring in obviously the tax rate. So this would be the tax rate method. But again, in the example, we used the tax table and they factor in all of this other excess income, etc. All right. So this brings us to our last question. Here it says, what is her gain or loss for tax purposes? Alex purchased a rental house 4 years ago for $270,000. Her depreciation at the time of sale is $40,000. Due to a decrease in real estate prices, she sells the house for only $240,000 in 2023. So, with this problem, simple math. We start off with the sales price. In this case, it lets us know that the home was sold for $240,000. And next, we need to factor in the adjusted basis of the home. So how do we factor that in? Now, let's look to the bottom. The original purchase price, the problem lets us know, was $270,000. The depreciation claimed was $40,000. So therefore, the adjusted basis of the home is $270,000, the purchase price, minus the depreciation claimed of $40,000. So the adjusted basis of the home is $230,000. So therefore, the gain in this situation would be the sales price of $240,000 minus the adjusted basis of $230,000. The gain in this case would be $10,000. All right. So again, this is just a brief overview of capital gains and losses. So that brings us to the end of Chapter 1's questions for the individual income tax return. We had the opportunity to look at the history of federal income taxation. We had the opportunity to look at some of the goals of the federal income tax system. We had the opportunity to review how we calculate gross income, adjusted income, taxable income, even the tax liability. So this brings us to the end of this homework review for Chapter 1, the individual income tax return.